Welcome to another edition of ICAN Online Tutors class. If you haven't subscribed to our YouTube channel, kindly go subscribe and click the bell notification. Also, if you haven't joined the premium class, kindly join the premium class. You can chat with the admin on WhatsApp via 08080665292 or 08185993275. The admin will be available to help you get into the WhatsApp premium class, which is exclusive. And those that have joined can testify that they're benefiting from it. So your instructor, Oriyomi Kasali, commence this class now.
Hello, good morning, everyone. Welcome to today's class. Today, we'll be commencing with group accounts. And the group account actually cut across the financial reporting and the corporate reporting. That's the reason why we'll be having a combined class for the first class. Kindly sit back and let's enjoy ourselves. I promise it to be an interactive class. Please be with your calculator, open your mind to learning, your writing materials, and everything should be ready. Today, we are starting with the rudiment of group accounts. When we say group account, what do we actually mean? What brings about a group accounting? What brings about consolidation? Your financial reporting or your corporate reporting is actually divided basically into two parts. The first part is that of the calculation, and the other part is that of the theoretical aspect. Permit me to say, aside from the standard, as we all know that the compulsory question usually comes from the group accounting. And with that, we have a lot to do. But let me tell you that the most easiest course to pass is a corporate reporting or financial reporting with ICAN Online Tutor. So let's get started. What is group accounting? At the end of this tutorial, I expected everyone to understand what group accounting is, to know the various types of investment and how such investment is being acquired, to know who a parent is and who a subsidiary company is, to know the types of acquisition and the various acquisition methods that we have. And also the most important aspect, which has put as the challenges for students, is the calculation of goodwills, which is goodwill calculation. Then the calculation of the consolidation. How do we consolidate when it comes to group accounting? From the diagram that you can see, you observe that we have a parent company and a subsidiary company. And both of them we are linking to what we call a contact. Because what we are having is what we call a contract of agreement. In a simple term, let's get started. Let's introduce ourselves to what a group account is. When we say group accounting, what brings about that group accounting? What brings about consolidation? Why the need for us to consolidate? Like you can see from the slide, they're buying a company or companies by just a shares, building up an entire building, actually goes about spreading a business activities. As you can all see, we all know a common business here in Nigeria. Let's take, for instance, Dangote group of companies. You can see that I said Dangote group of companies. When we say Dangote, we all know that Dangote does not only deal with a product. Dangote deals with varieties of businesses. That is why no matter where you go, you will see Dangote products here and there. Dangote cement, Dangote sugar, Dangote salt, etc. Who is a Dangote? It's just an individual company that started as a single entity, now started acquiring, buying more shares of another company so that it can have investment in that company. My dear professionals, that is what actually brings about group account and what we call consolidation. When we say consolidation, consolidation goes hand in hand with any business. But what does it actually mean? Many people refer to consolidation when they speak about their shares in other business in general. However, We need to differentiate between the individual types of investment in other business, because every type of the investment is accounted for in its own way. What do we mean? We need to differentiate the different types of investment that individual has in another companies. And by differentiating it, it will actually tell us and give us an idea of the types of holding that that person is actually having. If a person is having 1% shares up to 19% shares, we call that person an ordinary investor, or we call it simple investment. And that one actually falls under the categories of financial instrument. Obviously, we all know financial instrument is IAS 39. Yes, let me stop that. Also, if that same entity has investment in another company, but such investment is between the range of 20% and 50%, we call that one associate. When we say simple investment, or those people that we just call other subsidiaries or other shareholders, are those people that have investment of 1% to 19%. That is, their percentage of holding of shares is less than 20%. But if such person has between 20 to 50%, we said such investment is what? An associate. And obviously, according to the new standard, we are told that an associate should be accounted for using equity method. That's what IAS 28 says about equity for investment, about accounting for investment. But I can hear somebody asking, what about if I have 50% investment? What does that mean? If it is 50%, that one we call 50-50. That one is known as a what? Joint ventures. A joint venture is an holding that have exact 50% equity shares in another companies. And we so accounted for that one using a subsidiary method. That is, we refer to those sort of investment as that of the subsidiary. But a situation where someone owns 51% to 100% of shares in another company, such investment automatically becomes what? A parent company. And when someone is a parent company, obviously that person will have a control. Let's take, for instance, our parents. Our parents have control over us when we are still growing. That is why you will see that everything that we do rested on them. To eat, they are the one that cater for it. In fact, to plan for us, they are the one that even cater for it. A parent company has holdings. And what makes a company to become a parent company is when that company is having 51%. Note that the total equity shares of a company is known as 100%. If the total equity shares of a company is 100%, obviously if somebody is having 51 out of that 100, the remaining one will be what? 49. I can see someone nodding. That 49% are other subsidiaries. Why that of the 51% is known as the what? Parent companies. And the person that have the parent company automatically have what? Control over other companies. Let's take, for instance, if you are in a shareholders meeting. As we're in the shareholders meeting and we want to actually vote for a decision. Let's take, for instance, when Dangote wants to venture into a refinery. You know, Dangote is now doing his refinery business. If Dangote wants to venture into refinery now, and Dangote say, I have an idea. Let's do a refinery. Another shareholder saying, no, we don't want that. Don't let us do it. Okay, when they were arguing in a corporate organization, the only way we settled is by voting. If thousands of people raise their hands, and those people are having 49%, just one hand of 51% superseded others 49% equity holding. That is why we say parent company that's why we said a company that has 51% automatically have control over others. That is why it has control, and that is why we call it a parent company. You see that we have it in our side that why the other companies acquired are called what? Subsidiaries. Generally, control is when the parent company owns 51% and above of the equity shares of the subsidiary company. That is just what I just explained. So others that does not have control, what happens to them? As we can all see, either the percentage of interest is between 20% to 50%. If it is between 20% to 50%, we call that one an associate. An associate does not have a control, but have a significant influence. When we say significant influence, we mean the power to influence the decision of the management. Let's take, for instance, let me use an example that is so familiar to us, like our siblings. Let me say our brother. If you want to do something and your elder brother tells you, or your lecturer in speech just tells you that, why don't you look at it from this perspective? Before you react, before you make your final decision, you will want to observe the decision of that your senior person, because that person that is talking will be talking from experience and will also be speaking from what he knows. Is that taken? That is why we said associate has a significant influence. The significant influence is just a decision to have, an opinion to affect the decision of the management. But a situation where the percentage of holdings is less than 20%, as you can see, if it's less than 20%, that one is called ordinary investment. And that ordinary investment is what we call non-control interest. And that will only be accounted for or be treated under our non-control asset in the statement of financial position, otherwise known as balance sheet. I hope that is clear. Yes, let us define some basic concepts so that you can understand what we're saying. The first one that I would like to observe is what we call group accounting itself. In context, what is group account? When we say group account, we mean the account of the parent and that of the subsidiaries that is presented as if it is one entity. The account of the parent and the account of the subsidiary combined as if it is one company. Mr. A company, Mr. B company now join the two accounts together and present it as if it is a single entity. That is what we call group accounting. Having said that, the consolidated account combined that account that we've consolidated. When we say consolidated, we mean combined, join together, brings together so that it can look like one. That consolidated account, that it will combine all the information of the parent company, the information of the subsidiary company, also the information of subsidiary, if there is. Let's take, for instance, we have a parent company. Let me call that one, let me call the parent company, let me call it the father. I like using this example very well. The father. A father, while on his own, is known as a single entity. But because he cannot achieve more doing the business alone, he thinks he needs a partner. That is why he married the mother. when he married the mother, this father is known as the parent company. Don't forget that obviously we all said that the head of the house is the what? Is the father, or the head of the family is the father. And automatically the father is having a what? A control in the house. That father is regarded as the what? A parent company, as you can see on your screen. The mother, which is the person that the father acquired through marriage, is known as the what? Subsidiary. That subsidiary is the one that is divided into either an associate or what we call ordinary investor or ordinary holdings. And that ordinary holdings, let me use non-controlling interest for it. This is just an illustration of a parent and that of the subsidiary, as you can see on your screen. If the father and the mother now gave birth, then they'll be giving birth to, let me just use a child. This child can be regarded as subsidiary, but we are coming to that. What I just want us to get from this illustration is a father that acquired a mother is just a parent that acquired the subsidiary. The father will be having control over that of the mother. That is why we see that a mother cannot do anything without consulting the father. That does not mean that the father will also not be seeking advice from this person. No. But it's automatically having control over that of the what? Over that of the mother. That is why we said the parent company has control over the what? The mother. And what makes that parent company to have control is when you have 51% of the equity shares or more. 51% or more. 51% plus. Let me use plus. Now this is having 51% or more. When it's having 51%, automatically it becomes a what? A parent company, and it's having control over the other companies. Now, let's go back to the slide. I hope you get that simple illustration. That is what I mean by group accounting. And the group accounting will now, and the group company will now consolidate its account. We combine its account and presented it as one. The other one is significant influence. I've explained this while I was explaining the associate. But when we say significant influence, we mean the ability of the parent company to participate in the strategic and the operational decision of the company. And that one is what we call an associate. It's when associate decision, when it is influencing the decision of the parent company, we say significant influence exists. Obviously, when you are having 20 to 50%, you are an associate. And that association or that association is called significant influence. And when we say significant influence, it's just the ability to influence the decision of that parent company. Other incentives or other benefits that is available for the associate company is to be part of the board of the directors. It's also to contribute to the policy of that parent company. Having said that, we've been saying parent, subsidiary, associate, influence. Who is a parent? From the illustration that you can see earlier, we say a parent is a company that have one or more subsidiaries. We use an entity that has one or more subsidiaries. A father that acquired the mother and acquired the child, and also acquired another child, and also acquired another person. Is what we know as what? A parent company. A parent can be an entity, one company having many companies. One company with many companies. When I say companies, it can be one company under it, it can be two companies under it, it can be three companies under it or more. That is why I said one or more subsidiaries. Other companies that I mean is what I refer to as subsidiaries, because obviously you are a professional, you are not expected to be saying companies. You have to be using the word subsidiary. That is the terms that we use. And who is this subsidiary? Subsidiary is an entity that is controlled by another entity. That is a company under another company. Are we together? Yes, I can hear someone say yes. So what we will be dealing with in group account? The first thing that we have when you see a question under a group account, or you are given a question under a group account, whether you are doing financial reporting or you are doing corporate reporting, the first and foremost is to determine the investment of that company in another company. When we say determine the types of investment, I mean, what is the percentage of investment of that company in another company? Obviously, the first thing is for you to identify who a parent company is and who is subsidiaries. We all know by now that a parent company is the one that acquires another company. The acquirer, the person that acquires another company, is called parent. Acquiree, the person that is being acquired or an entity that is being acquired, is what we call subsidiary. Is that taken? And having said that, when you identify acquirer and acquiree, that is the parent and the subsidiary, then determine the types of investment of that parent company in that subsidiary. That will give you a clue whether the person is having full control or partial control. When I say full control might be 100% and it might be less. But control exists from 51% and above. Then the next thing is, having determined the percentage of holdings, then what is the next thing for me to do? We shall discuss that. But before we go into that, let's clearly look at the appropriate IFRS, the various IFRS standards that talks on the group accounts. Basically, we have 6 standards that talks on group accounts. The first one is what is known as IAS 27. When we say IAS 27, we mean separate financial statement. When we are doing standard, we're going to talk more on all the standard has been analyzed. But it should be a benefit for you doing a group accounting, because this is standard actually cut across group accounting and discuss more on when an entity acquired another entity and the various ways we need to go while we are accounting for consolidation. When we say IAS 27, which is separate financial statement, that one actually talks on how investors should present its investment in individual or separate financial statement. IAS 27 actually talks about the consolidation procedure. That is, when is a company expected to consolidate? When are you not expected to consolidate? What are the various things that you should look for that we know that you are exempted from consolidation? That is what IAS 27 talks about. All this, we still examine it. The next standard is IAS 28. And as you can see, IAS 28 is just all about investment in associates. That is an associate accounting. And what is particular to IAS 28 is that investment in associates should be accounted for using an equity method. Why? Because an equity method would show, you all know what we call an equity. Yeah, when we go to the question and answer, please just be noting your question. Be noting them down. I'm going to answer all your questions. Just note them down. When we say equity, you all know what an equity is. Equity is the share capital, or that one you call ordinary share. When you look at your statement of financial position, otherwise known as balance sheet, you have ordinary shares, general reserves, share premium, retained earnings. All those items are what we call your what? Equity. And IS 28 is particular about using that equity method to account for your shares in another company. That is just what IS 28 is talking about. The next one, which is the next standard, is IFRS 3, known as business combination. Obviously, we said it from the introduction that when we say consolidate, we mean to combine, to bring together, to join as one. That is what IFRS 3 is saying, business combination. Business combination, IFRS 3, just outlining the accounting that investors should obtain a control over its investment before it can consolidate. That is, if you are having a shares of 50%, you cannot consolidate. You cannot prepare consolidated financial statements. Instead, you can prepare investment in associate using equity method. But the moment you are having 51%, from that, you've started preparing what? Consolidated financial statements. Yes, I have it that people are often confused because IFRS 3 and IFRS 10 deals with this situation, but the situation is different. IFRS 3 tells us what business combination is, how to account for it when we perform consolidation afterward. Why IFRS 10 only deals with what? Measurement of goodwill, non-controlling interest, assets and liabilities that is being acquired. Obviously, IFRS 10 is also the next standard known as Consolidated Financial Statement. And that Consolidated Financial Statement is just is to commemorate that of the IFRS 3, is to support IFRS 3, known as business combination. IFRS 10 Consolidated Financial Statement, this with the situation when investors acquired control over the investment. IFRS 10 now says your consolidation procedure shows the goodwill, the asset, and the liability that has been acquired. Show whether the goodwill is having a positive goodwill or negative goodwill, known as bargain on purchase consideration. All this we are going to observe during the course of our lecture. The next one is what is known as IFRS 11, which is the joint arrangement. And IFRS 11 joint arrangement or a joint venture is just showing the investment that is having a 50-50 investment. The next one is IFRS 12, disclosure of interest in other entity. That disclosure of interest in other entity is particular about the types of interest that a company is having in another company. Is it a subsidiaries interest? Is it an associate interest? Is it a joint arrangement interest? Or is it ordinary investment? That is just what IFRS 12 is saying. That let us know the types of investment that you are having in other entities. That's how we call it disclosure of interest in other entities. I hope we are together. So now, let's go to the basic aspects. And this always comes out in our examination. First, what are the conditions that can make an entity to consolidate? What are the situations that might make an entity not to consolidate? First, for an entity that acquire another entity, that entity can prepare consolidated financial statement where one, the two companies adopt the same reporting dates. The second one, there's uniformity in their accounting policy. I hope this is clear. I can see somebody saying yes. When we say same reporting date, we mean if a financial reporting end date is 31st of December, the subsidiary company should also be 31st of December. If one is March and another one is December, it is not the same reporting date. It's either they change it or they use the same thing. When it is maintained, such entity cannot consolidate. But if it is the same reporting entity, the standard have it that they should consolidate. Consolidate means a parent company should prepare the account of its own and that of the company that he acquired as that of the single entity financial statement. The second one is uniformity in their accounting policy. Remember that IAS 8, changes in accounting estimates, errors, states that an entity is expected to maintain an accounting policy for a foreseeable years. And when such entity wanted to change an accounting policy, such should be stated. And there's no way that we change an accounting entity except where there's a change in standard or where there's a change in regulation. What does that mean? It means the IAS 8, when we get there, we're going to discuss more on that. It says an entity is expected to maintain one accounting entity. If your own entity has been adopting Accrual, maintain that Accrual. If it is maintaining a cash, maintain that cash. You are not expected to be changing accounting policies. So for an entity to consolidate, it means you must have a uniform accounting policy. Having said that, those are the two basic significant that can make an entity to consolidate. Another condition where parent company is exempted from preparing a group account or exempted from consolidation is what I term as humidist. HUMIDIST. That is the acronyms that I've actually used so that students can get it better. And I'm going to explain all this for a better understanding. Humidist is HUMIDIST. It's an acronym for you to remember. And it is used in a situation where a parent company might be exempted from consolidation. The first one is AMFU. I'm taking the acronyms one after the other. The first H denotes what? AMFU. When we say AMFU, AMFU means where a parent company see that preparing a consolidation financial statement will be harmful to its activities. In such situation, the standard exempts the parent company from consolidation. That is, when the parent company wants to prepare a consolidated financial statement, it will cause harm for the entity. In such situation, do not consolidate. The second one is when you see that it will result to unnecessary expense. When we say unnecessary expense, we mean it will make the parent company to spend more money because you want to consolidate. As a result of that, the standard habits that do not what? Consolidate. Another one is when you see that it will result to misleading. Misleading is when the parent company see that the activities of preparing a consolidation financial statement would mislead the users of such financial statement. In such situation, the standard exempts the parent company from consolidation. I hope that is clear. The next acronym is I, and I have it as what? Impracticable. When the parent company see that it will be impracticable for him to prepare a group financial statement, then do not consolidate. Another one is when the two company activities are different, when they are not in the same line of activities. That is what we call different activities. Different activities is where the two companies are not in the same line of business. For example, one is in a leather business, another one is in a manufacturing business. No, sorry, one is in a manufacturing business, another one is in a service business. If the two companies are not in the same line, or one is a financial institution and another one is a manufacturing company, in such situation, do not consolidate because the two companies are not in the same line of business. And that's what we call different activities. The next one is what? Insignificant. When you see that it is not significant for it to consolidate, then we refer with the standard habit that it should be exempted from preparing consolidated financial statements. That's why we call it insignificant. That is, it's having a little or no influence in consolidation. Another one is severe restriction, where that company has been restricted over time. Then it said, do not consolidate. The last from the acronyms is what is known as what? Temporal holding, where the parent company does not acquire that company in full. It is just a temporal holding. When we say temporal holding, it's just managing that company, not that it gain a full control on it. For instance, where Mr. A has the right to manage a company for a certain period of time. In that situation, it is a temporal holding. It's just having control over the company for a limited time. It does not acquire the company in full. I hope that is clear. Do not forget, UMIDIST, H for harmful, U for unnecessary expense, M for misleading, I for impracticable, D for different activities, I for insignificant, S for severe restriction, T for temporal holdings. Harmful is when you see that the activities of the subsidiary company will be harmful when consolidated, would affect the business when consolidated, then do not consolidate. Unnecessary expense, it will result to the parent company spending more money to consolidate, then do not do it. Misleading, it will mislead, it will lead astray the users of the financial information, then do not consolidate. Impracticable, when the parent company see that it is not practicable to consolidate that financial statement, then do not consolidate, but what? State it under the note under financial statement, the such investment that you are having in another company. That's all. Then the different activities, when the two companies are not in the same line of business. Insignificant, when you see that it is not material to consolidate. Severe restriction, when you see that there are restrictions on either that company or the parent company, then do not consolidate. Then the final one is when there's a temporal holdings. Given that 8 points is more than enough for you. So some of the aspects that we'll be looking at under group accounting includes simple group. When we say simple group, we mean the account of the parent company and subsidiary. That is one parent, one subsidiary. I call that one basic group. That's why I call it simple group. So it can be known as what? Basic group consolidation. Is that taken? Basic group consolidation. Another one is fellow subsidiary. That is one subsidiary, one parent company with many subsidiaries. That is a parent company and another companies. Then subsidiary is a parent company that have many subsidiaries. Another one is complex group, and that one is for the corporate reporting. For the way, we have de facto, the one that is acquired based on fact. Foreign subsidiary, piecemeal acquisition. Then group cash flow is for the corporate reporting, while FR is just simple cash flows. All this and many more we are going to examine during the course of our lecture. Okay, let's quickly look for how to account for investment. As I've already mentioned above in our previous slide, you should first determine what types of investment you deal with based on the types and applying the appropriate accounting treatment when it comes to consolidation. I hope from the previous explanation, by now you should have understood the types of investment, the types of subsidiaries, and how the various standards that is applicable for consolidation. Also, I believe that we now know a situation where we can consolidate and a situation where a parent company is exempted from preparing a consolidated financial statement. Let me quickly tell us that basically we have 4 types of investment. All this we're going to discuss. We have the first one, which is known as subsidiaries. And I hope we've discussed on what a subsidiary is. A subsidiary are other investment from what? 50% downward. 50% downward. From 50%, you can still call it an associate. You can still call it a joint venture. And when it is less than that, it is called what? Subsidiaries. Remember that we said a subsidiary is an entity that is controlled by another entity. And if there's a control, then the investors must account for such investment using the word acquisition method and apply full consolidation procedure when making consolidated financial statements. The second one is an associate. We've actually discussed what an associate is in our previous slide. And we said an associate is an entity over which an investor has a significant influence and which is neither a subsidiary and neither a joint venturer. What do we mean? An associate company is the one that is not a subsidiary, and it is not a joint venturer. It is an investor between 20 to 50% acquisition. Is that taken? So if there's a significant influence, then investors must account for such investment using what? Equity method. We have stated this earlier. And as you can see, that the basic indicator of significant influence is that the investors will have a share between 20 to 50%. Do not forget, we have 20 to 50% investment. Where there is 20 to 50% investment, you will call such investment associate. Call such investment associate. Is that taken? And then, but a situation where significant influence might or might not be demonstrated regardless the size of the ownership is that of when there is a what? Subsidiary. When there is a control is from what? 51%. Do not get yourself confused. Associate is just between 20% to 50%, and you account for investment in associate using equity method. Having said that, another one is what is known as joint arrangement. joint arrangement. And it is IFRS 11 that discuss on that. We've looked at that during our previous slide. IFRS 11 say define joint arrangement as the arrangement between two or more parties who have joint control. When we say joint arrangement arises from a situation where both of us are having the same business idea. And we just say, okay, conference, I have an idea. Let's quickly do a business that could fetch us money. And that one too are agreed. In joint venture, there's a mutual aim. Both of us are having a similar aim. And the similar aim is to carry on a business for a specified period of time. When we say, for a joint venture, the business is not for a going concern. It's for a business that will lapse in the near future. A business that does not lapse more than 1 to 5 years. That's what we call a joint arrangement. And the motives of that joint arrangement is just to make a profit. That is why we said it is the arrangement between two or more parties who have a mutual aim or who have a joint control. Each party have equal control. Both of us, we just divide our work. You, this is what you do. You, this is what you do. And the types of account that we prepare is what is known as a joint ventures account. So let's move on. It does not make any sense to quantify the share in joint venture. Take note of that. Take note of that. We are not quantifying the shares in joint venture because it should not be equal for all the parties. Because it should be equal for all the parties. Remember that I said we are having a mutual aim, and each of the parties are having a what? A similar control. Both of them are having equal control. So not that one will be having a share that is larger than the other. No. It is mutual aim. Both of us are having a similar aim. Then both of us, we are sharing both the risks and reward. So it is equal, 50-50. No one that is equal. No one that is greater, no one that is less. Both of us are having what? 50-50 share. That is why we will not be quantifying the shares in joint arrangement. If it is two parties, we said they are having 50-50 shares. If it is three parties, we say they are having, just divide 100 by 3. That's 33.3. And that is what I illustrated here. If there are three parties, each party has what? 33.3333% of shares. I hope you get the idea. I can see somebody nodding. Yes. Instead, parties need to exercise joint control over the arrangement. It means that the important decisions required the unanimous consent of all the parties in the arrangement, and no single party can decide independently. No single parties can decide independently. Let's assume we are 3 in the business. Nobody out of the 3, one person cannot be doing something in his own aim. Before you do anything, seek the ideas of the other 2. If you agree, fine. If you do not agree, then such thing will not hold. That is what we call mutual aim, joint arrangements. No one is above the other. We are all equal. Decisions should be taken equally. Profit should be taken equally. Loss should be taken equally. Risks should be taken equally. Reward should be taken equally. The work should be divided equally. The activities should be undertaken equally. No one is above the other. I hope you are getting it right. So IFRS 11 requires accounting for joint arrangement based on the word specified type. what are the specific type? One, if the party establish joint venture, then each party account for its investment using what? Equity method in line with IAS 28. Is that taken? If parties establish joint venture, then that parties must account for their investment using the what? Equity method in line with IAS 28. Remember that IAS 28 talks on investment in associate, and the investment in associates is just between 20 to 50%. If it is true, that is 50-50. And that 50-50, we have to use the equity method. And two, the second one, if parties establish joint operation, if it is a joint operation, then each party account for its own assets, liabilities, expenses, revenue, and its shares on all items incurred jointly. This is where we have a joint venture account. Remember, during our undergraduate level, we always prepare a joint venture account of a joint venturer, where we first of all prepare a joint memorandum account, a memorandum account. Joint venture memorandum account, note that is the principal account known as the main account. And that one will have the summary of the total activities of the business. And in that, it will have a share of profits to the joint venturers. I hope that is clear. We are going to get everything in the course of our lecture. Let's look at the fourth one. The fourth one is other investments. And that other investment is just if an investor acquires any other investment that does not fall in any of the above three categories that is mentioned in the previous slide. Just account for that account using what? IAS 39 and IFRS 9, financial instrument. Is that taken? Okay. Let's quickly look at business combination, IFRS 3. Let's quickly go to IFRS 3 in order not to waste much of our time. In IFRS 3, what does IFRS 3 state? IFRS 3, which is known as business combination. Remember that we've discussed this earlier. But what is particular about IFRS 3 is what I actually want us to discuss. And that is why we are bringing IFRS 3 as a subtopic. It is impetus to note that the objective of IFRS, it is important to note that the objective of IFRS 3 business combination is to improve the relevance, reliability, and comparability of the information that the reporting entity provides in its financial statement about the business combination and its effects. Take note. Most especially, IFRS 3 established the principles and requirements for how the acquirer, that is, acquirer is an entity that acquires another entity, known as the what? The parent entity or the parent company. And states is particular about the parent company recognizes and measures the identifiable net asset acquired. Identifiable net asset acquired. That is, the liability assumes and any non-controlling interest in the acquiree. What do we mean? IFRS 3 is particular about what is the percentage of the asset acquired. What is the percentage of investment of the parent company? And what is the remaining that was not acquired? The one acquired is called holdings. Are we getting it? It's called purchase consideration. And the other one that is not acquired is called non-controlling interest. The first one is called controlled interest. The other one not acquired is called non-controlling interest, NCI. Non-controlling interest, NCI. What is the percentage acquired? Then what is the percentage not acquired? That is what IFRS 3 is all about. And the second one is how to recognize and measure the goodwill that is acquired in order to determine whether there is a positive goodwill or a negative goodwill. A positive goodwill is when the purchase consideration is more than the net asset acquired. But if otherwise, we said we have a negative goodwill. Negative goodwill is what we call gain on bargain purchase. Gain on bargain purchase is what we call negative goodwill. Negative goodwill. Negative goodwill is the same thing as gain from bargain purchase. Gain from bargain purchase. So it's the same thing as what? Negative goodwill. I hope that is clear. So another one is to disclose, to determine the information to disclose about business combination. That is what IFRS 3 is talking about. And IFRS 3 business combination also states that goodwill shall be recognized as a date of the acquisition as the difference between one, the aggregate of cost of investment in subsidiary by the parent company and the value of NCI. The aggregate of cost of investment in subsidiary by the parent company and the value of NCI. And two, subsidiary net asset as at the date of acquisition. All this, we are going to illustrate it practically, and you will get it with ease. Note that if the subsidiary net asset at the date of acquisition is greater than purchase consideration, then we have goodwill, and that goodwill, we call it positive goodwill. I've said that earlier. Note that if the subsidiary net asset at the date of acquisition is less than the purchase consideration, you have positive goodwill. But if it is greater than the purchase consideration, then we have negative goodwill, known as gain on bargain purchase. That is what I just mentioned in the previous slide. Now, what are the formats of goodwill calculation? How do we calculate goodwill? The format for goodwill includes the first one, cost of investment, or consideration transferred. You can also call it consideration transferred. Cost of investment is the amount that is being paid to acquire the subsidiary company. That is what we call consideration transferred. Amount that is being paid to the subsidiary company. We now add NCI value at DOA. NCI value at DOA. NCI value is non-controlling interest that was acquired as at the date of acquisition. Are we together? If you add the two together, this plus this will give us what is known as purchase consideration. If you add this value, let me use Naira sign for instance. If you add this and this together, it will give us what is known as purchase consideration. Then if you deduct subsidiary net asset, you are going to have either positive goodwill or negative goodwill. That is just the format. All this we are going to illustrate practically in the subsequent of our subsequent workings. We are going to see it how we are going to calculate goodwill, and we are going to use a good scenario to account for that. So having discussed goodwill, the next one that is also important to our examination is investment in associates. Investment in associate. When we say investment in associate, how do we account for investment in associate? And this is one of a key thing that ICAN has actually been bringing in the examination over the years. Over the past diet, we see ICAN that is texting it very well. So let's quickly go to investment in associates. First, we've defined investment in associates over numbers of time, but I will repeat here for full understanding and to buttress the facts. Investment in associate refers to the investment in an entity in which the investors have significant influence, but does not have a full control like a parent company and a subsidiary relationship. Usually, the investors have significant influence when it has 20 to 50% of shares of another entity. We have emphasized on this several times. Accounting for investment in associates. How do we account for investment in associates? One, accounting for investment in associates is done using the equity method, IFRS 28. We mentioned that earlier. In the equity method, there's not a 100% consolidation used. Instead, the proportion of shares owned by the investors will be shown as an investment in what? Accounting. You know, we said investment in associate is between 20 to 50%. Let's now assume that the company acquires 30%. Example, let's take for instance, a company have investment. A has investment in B Limited, acquired several years ago, 30% investment, acquired 30 years ago, or acquired some years ago, and such investment is 600 Naira, for instance. So what equity method is saying is, do not take 600 as investment in associate. Instead, use the percentage acquired, the percentage of shares acquired by that investor to calculate for the investment, to calculate for such investment. That is, you just have 30% of what? 600 Naira. And 30% of 600 Naira will give us what? I hope you are punching your calculator. So when we say 30% of 600 Naira, obviously will give us 180. So 180 Naira is what? The investment that A is having in B. And this is what IS 28 is talking about. That is what we mean by equity method. So when an investor takes some shares in associate, then in the balance sheet of the investor, it is recorded as what? Increase in associate. And cash gets reduced by the same amount. We have a question to illustrate this. The dividend from the associate is shown as an increase in cash for the investors. To record the proportion of the net of the income of the associate, the investment revenues of investor get credited, and the investment in the associate will now be what? Debited. Don't worry, we will illustrate this. We have already defined what an associate is. By now, we know what a significant influence is. We have discussed that in our previous slide. But equity method, like I mentioned earlier, that equity method is a method of accounting by which an equity investment is initially recorded at cost and subsequently adjusted to reflect the investor's shares of the net asset of the associate. And the identification of associates includes an holding between 20% to 50%. We have said that earlier. If the holdings is less than 20%, the investor will presume not to have a significant influence, and such will only be treated as ordinary investment. From our first slide, we said investment from 1% to 19% will be treated as what? Ordinary investment. Why 20 to 50 is what we're discussing, known as investment in associates. And in our previous slide, we said some of the benefits that is available for having investment between 20 to 50%, which will cause significant influence. We said it includes representation as the board of the director, participation in the policy making, material transaction between the investors and the investee, interchange of managerial personnel, provision of essential technical information, and any other as may be influenced by the board of directors. Let's go. When we account for equity method, how do we account? That will take us to some of the applications in equity method. The first one is basic principle. All this we are going to illustrate practically. We're going to use a practical example for it. The basic principle. Under the equity method of accounting, the equity investment is initially recorded at cost. We said that earlier, and subsequently adjusted to reflect the investor's shares of the net profit or loss of that of the what? Associate. And the goodwill, the implicit goodwill and the fair value adjustment on acquisition of the investment in associate, any difference, whether positive or negative, between the cost of acquisition and the investor's shares of the fair value of the net identifiable net asset of the associate is accounted for like that of the goodwill, just as we've accounted for goodwill under IFRS 3 business combination. It's the same way we will accounted for any goodwill or the fair value adjustment of that of the associate. Note that appropriate adjustment to the investor's shares of profit or loss after acquisition are made to account for additional depreciation or amortizations of the associate depreciable or amortization of the asset based on the excess of the fair value over the carrying amount. But when there's impairment, we use impairment indicator as stated in IS 39, financial instrument. And that one actually talks about the recognition and measurement. IS 39 is recognition and measurement. The completion of the financial instrument is that of IFRS 9, which talks on about accounting entry and what? Disclosure. Recognition and measurement apply to investment in associates. Just as IS 28, if investment is indicated, then the amount is calculated using IS 36 of impairment of assets. And the entire carrying amount of the investment is texted for impairment as a single asset. That is, goodwill will not be texted separately. And the recoverable amount of an investment in an associate is assets for each individual associate, unless the associate does not generate cash flows independently. And a situation where to discontinue the equity method is, the standard says use the equity method. The equity method should cease. We should cease using equity method from the date that significant influence ceases. That is, when there's a reclassification of investment, and that such reclassification does not meet the required, does not meet investment for associates, that is, it is not up to 20 to 50% again, then do not use equity method. Instead, treat this as non-controlling interest. Is that taking? I can see somebody saying yes. Let's take, for instance, we want to illustrate how to account for investment in associate. Let's go through the question. Let's say company ABC purchased 30% shares of XYZ company. That means ABC, look at the question. Company ABC purchased 30% share of company XYZ. If I ask you, what is ABC having in XYZ? I hope that you will tell me that ABC is an associate of XYZ company. And as such, is having a significant influence. Is that not? Yes. That means ABC has what? Significant influence over what? XYZ. And XYZ cannot be treated as an associate of what? ABC. Now, how do we now value the 30% shares? Let's say the value of the 30% share is $500,000. If it is $500,000, so when making purchase, the below are the accounting transaction for ABC. Remember, when ABC purchased shares in XYZ, he purchased the shares at $500,000. When we look at the percentage of the shares that is being purchased, we see that the percentage is 30%. The 30% is measured as what? The 30% value is $500,000. So initially, you will account for investment in associate. Debit, when you account for it, definitely the shares of this thing would increase. So that is why you debit $500,000. Because you are paying cash, your cash will reduce. So instead, reduce cash by what? $500. So you credit cash and you debit investment in associates. Is that taking? So let's say after 6 months, XYZ declares $10,000. XYZ declared $10,000 dividends to its shareholder. That means ABC will now receive 30%. Okay, ABC will now receive 30% of the dividend of the what? 3 million naira. Are we together? If you are following, kindly type yes and let me know that you're actually getting it. Are we together?
Kindly type yes in the chat if you are following. Abel is well, okay.
I hope the slide is clear, the chat box. Okay. Let me take it again. We say ABC acquired 30% shares of XYZ. And the value of that shares is $500,000. If it is $500,000, first determine the types of investment. That types of investment is what? An associate, because it is between 20 to 50. 30 qualify it as what? An associate. As a result of that, ABC is having significant influence in XYZ. So far as having significant influence, we are going to account for it using equity method. Now, initially, when ABC invests, its investment, its equity will what? Increases. And all assets, simple account, all assets must be what? Debited. You still remember, right? All right. So debit your investment, 500,000 naira. That's why we debited this. When you debit, you know, all accounts has two legs, debit and credit. When you debit your 500,000, the second leg is what you are paying. Obviously, you are paying out money. That is cash. So credit your cash because cash is given out and investment is receiving. The account that is receiving will be debited. The one that is given out will be credited. We are now doing simple accounting now. So credit your cash. That is just what we've done here. You've debited your investment that is receiving because your investment would increase. And we debit the cash because when you take out money from the cash, definitely your cash will reduce. So you credit cash that reduce. That is the first stage. So let's proceed. Let's say after 6 months, that company XYZ in which ABC invested in now declared a dividend of 10,000 naira. CO, he declared a dividend of 10,000. Dividend declared is 10,000. What is the percentage of control? What is the percentage of your own investment? So you now say 30%. 30% of $10,000 dividend declared. What will he give you? Let's do it. 3 times 1,000. You will agree with me that that is what? $30,000. Is that not so? That is your percentage of holding. You hold 30% and they declared 10% dividend. Definitely, your own dividend, your own shares of profit will be 30% of that profit declared. And that is the 30% of the what? $10,000 declared. So 30% of the 10,000, 30% of the 10,000 will give you what? $30,000. And that 30,000, it means you will be receiving 30,000. So that 30,000, how will you do it? Now your cash is receiving. Is that not? But remember, that is also from the investment. So the reverse is the case. Debit your cash and credit your what? Investment for such money, which is what? 3,000 naira, 3,000.
Okay, so everybody, we will give you opportunity to unmute yourself now and ask questions. So if you have any question, just simply raise up your hand. I think somebody raised his hand. Okay, if you have any questions, raise up your hand. Let's give you the opportunity to ask your questions at this point. Okay. I think somebody's raising his hand. Okay, nobody's raising. I guess everybody is following. Okay. Olayinka Banks Adesoya, I would unmute you now. Okay, you can ask your question. So I've asked you to unmute. Yeah, so ask your question.
Okay, good morning, everyone. Okay, it's just to correct that calculation because it's 30% of 10,000 and we're seeing $30,000. It shouldn't be.
Oh, sorry.
3,000, not
It's
30.
3,000. Thank you. 1,000 times 3 is 3,000.
Okay, Olayinka Banks, thank you so much.
Thank you for that. So it is 3,000 and not 10,000 and not 30,000. It is 3,000. So it is 30% of 10,000 that will give you what? 3,000, not 30. Thank you very much for that observation. So that 3,000 will be debited under cash, and we are going to credit our investment as what? 3,000 naira. I hope that is clear. That is what we received from that investment. It is what we received from the investment. That is why we are still crediting investment and we are debiting the cash. It is still.
Okay, please hold on. Okay, Chilotam, you said I don't get it. I can see it in the chat. So I'm going to unmute you now and give you the opportunity to ask. Also, Abel as well. I'll give you both of you the opportunity to ask your questions now. So I will start with Abel as well. Kindly unmute yourself and ask questions. What don't you understand? Okay, seems Abel as well is not available. So Chilotam, I'll give you the opportunity to. Okay. Chilotam says everything is okay now. So Mr. Oriyomi, please continue.
Okay. Since we've gotten that, so can we go to the next slide? We're still on investment in associate. Please, if you are not getting anything, kindly signify so that we can clarify it. Because investment in associate is a crucial part and it's one of the focus area for ICAN, whether financial reporting or corporate reporting. That is why we actually bring it out to explain it in details. And after this, we'll only be coming across it when we are doing our full consolidation account. All right. While I'm waiting for the question, let's go ahead with that question. Remember, let's look at it again. Initially, ABC has 30% investment in XYZ. That 30% qualify ABC as an associate of XYZ. Then what ABC is having in XYZ is what we call significant influence. IS 28 says account for investment in associates using equity method. Please, the major pitfall of students when it comes to investment in associate is they do not even understand what an equity method is. That is why I said equity method is just a percentage of the holdings of shares you are having using the proportionate of shares. As simple as that. The proportionate of shares is what we are doing. Please pay close attention. And if you're not getting anything, please signify. Because after this, we might not actually be bringing it out as this, except you are one of our premium students. Okay? Obviously, you are going to still have more questions on this, in which we have more questions to solve as a premium student. Please do not hesitate to subscribe. So as I was saying, the value of that 30% is $500,000. 30% of 500,000 will give you the value of that share. But first of all, what you first of all need to account for is that share, that money that you give out. Initially, when you give out, when you buy shares, let's use a layman language. When you buy shares, you all know that your share will increase, right? Shares will increase. Share will increase. Then your cash or your bank will what? Will reduce. Is that not? Because why is cash or bank reducing? It's because you are giving out that money. Remember that this share that you bought, is not a paper. It is in terms of money. But it is denoted using a percentage, which is the 30%. That is what we recognize in our simple accounting, that your cash increases, debit it. Your investment increases, debit it. Your cash reduces, credit it. When you credit, it reduces. So after 6 months, the company now declared a dividend of $10,000. When you declare a dividend of $10,000, you are not the one that owns that $10,000. Dividend is a profit that is available for distribution. All shareholders, everybody that owns shares in that company, have that $10,000 based on the numbers of shares that you have. This is now what equity method is saying. How much is your own share from that 10,000 naira, from that $10,000? For you to know how much your own shares is, how much is the shares that you are holding? What percentage of shares are you holding? You are holding 30%. Don't forget. Let me circle this 30. So that 30% is that 30% multiplied by how the profit declared. Profit declared is $100,000. So 30% of $100,000 is 0 cancel 0, 0 cancel 0. So 1,000 times 3 will give you what? 3,000. That 3,000 is your what? $3,000 is the amount you are receiving from that dividend. So, having received it, what happens again? Your investment decreases, Abi, because you agree that the investment is given out. Any account that is given out, you credit. The one that is receiving, you debit. That's why we debited cash and credit what? Investment. Using simple accounting. I hope that is clear. I can see somebody nodding yes. So let's go to the next slide. Let's now assume that XYZ also declared a net income of 50,000 naira. That company that you invested in also declared $50,000. Where it declared net income of $50,000, what is your own share from that $50,000? I said ABC will debit 30% of what? That $50,000 in its investment in associate account, while crediting the same amount in the what? Investment revenue. Do you remember? All what you are doing is your what? Just be finding the 30%, because that is what concerns you. That is your own interest. And where you might be having challenges, and which is not a challenge, is which account am I debiting and crediting? Don't be too hard on yourself. Use your simple illustration. The one receiving is debited. Every account has 2 legs. The one receiving is debited. The one giving out is credited. We call it net income. What is income? Income is revenue. Is that not? I can see yes. When we say income, you know, income is revenue. So your investment in associate, 30% of 50,000 will give you 15. You cannot find, just calculate 30% of $50,000. It will give you 3 times 5, 15. It will give you $15,000. That $15,000, debit your investment in associate and credit your what? Revenue. So at the end of the whole exercise, what do we have? Now prepare your ledger. That is, if the question extends to these 3 illustrations that I've given. How does the journal looks like? The first one, we started from investment in associate, which is the amount that he invested. Invested 500,000 naira. We debit investment in associate and credit the cash. After dividend was paid, we debit cash for 3,000 naira and credit what? Investment with the same $3,000. After declaring the net income, we debited investment in associate for 15,000 and we credited what? Investment in revenue. Don't forget, all what we're doing is investment in associate, investment in associate, investment in associate. I hope you cannot see it. Obviously, when you are preparing your consolidated financial statement, we are going to look at the steps, the various ways to prepare consolidated financial statements. And ICAN Online Tutor will give you a standard format that we've texted and trusted. If we give you a standard format, please just follow that format. Under that format, you already have the investment, how to account for investment in associate as part of the working note. And that one is using equity method. What you are just doing is just account for the percentage of interest you are having in it and calculate based on amount that is invested. And if there's any share of profits as well, as given in this question, account for it using your percentage of interest in that company. That is all about investment in associate. Any question on that before we proceed? While waiting for a question, if there's one, the important point to note about change in investment in associate is that a company is treated as an associate when it has an interest between 20% and 50%. That's a summary of all what we've done. Equity method is used to do the accounting. Do not forget, please, do not forget that equity method is just your percentage of holdings, your percentage of investment multiplied by the amount invested. And if there's any share of profit, your percentage of holdings multiplied by the shares of profit. That is your equity method. Then the summation of it is what you needed. Then investment in associate is treated as an asset, and only the percentage of shares bought is treated as what? Investment. This is just what I explained now. Dividends, if any, are treated as change in investment and not dividend revenue. This is the case. Dividend is treated as change in investment and not revenue. If there's any dividend, please treat it as a what? Investment. All right, in rounding up investment in associate, it is my pleasure to tell you that investment in associate is a common practice for companies to use their investment where they want to take a lesser stake in another company. Then the equity method is useful for the accounting process for this investment because it actually shows the percentage of holdings of one company in another. Though company can show the net income of the associate company as part of their revenue. However, dividend income won't be part of it, and it will be a reduction in investment in associate assets. That is all. I think that is cleared under investment in associate. That is all about investment in associate. Let's eat the bull on the head. Is that taken? If that is cleared, say yes. If that explanation is cleared, type yes. Let me know that we are following. Because to me, we are done with part 1. And that is all about investment in associate. Please go through what is discussed. Even after this session, if you have a question, please drop it. The instructor will be available to answer you at any point in time. And do not forget to subscribe to our premium class so that you can have more advantages and more questions to practice to actually improve your understanding and to give you a chance for your ICAN examination success. ICAN Online Tutor is there to help you achieve your career aim with ease. Please do not hesitate to subscribe. Having gotten that, let's now go to main aim. That's why I said, let's hit the bull on the head. How do we consolidate? What is the basic point for consolidation? These are some of what we cannot get in other things. So let's quickly discuss it. And please, just as we pay attention to the investment in associate, your full attention is needed here too. Everything we are going to discuss here is with illustration. And having discussed that, I can bet it with you that under any question under group accounting, under consolidation, you will solve it and give kudos to ICAN Online Tutor. Yes, I'm proud of that. In the process of parent company acquiring the subsidiary company, some transactions will be made to validate the agreement. You know, everything is a contract, it's an agreement. Remember, from the first diagram, you have parent company, you have subsidiary company, and both of them you have contract because it is a contract of agreement. If A wants to acquire B and B say no, nothing it can do. Look at the case of Access Bank and that of the Diamond. When Access Bank proposed to Diamond Bank, if Diamond Bank will reject, nothing that Access Bank will do. They will rather find their investment in another company. Oh my goodness. I even forgot to tell you that investment in associate is a typical example of that of the Access Bank and Diamond Bank. It is a typical example. Investment in associate is a typical example of Access Bank and Diamond Bank. Because they said they were having what? It is not a full acquisition. It is just an interest in Diamond. So that is a typical example, by the way. So this transaction of parent company acquiring subsidiary company is in form of purchase consideration, or what we call cost of investment. So what is this cost of investment, or what is this purchase consideration? When we say cost of investment, let me use a layman language first. When we say cost of investment, let me tell you that cost of investment is the amount you pay to acquire a subsidiary. That's all. That is a layman. The money you paid to acquire your subsidiary. So what is that amount? What is that money? How was the money paid? It's what we want to look. It's what we want to look into. And then, is there any other way, aside from paying cash, that the parent company might have adopted in acquiring subsidiary company? Sorry, I don't want to use a big English. That is why I'm trying to break everything down. When we say cost of investment, it is the amount of, or the fair value of consideration given up to acquire the subsidiary company. What did I say? The amount of, or the fair value of consideration given up to acquire subsidiary by the parent companies. It is what the parent company gives up to acquire the subsidiary company that we call cost of investment. And it includes the following. One, it can be in form of cash payment. Two, it might be in form of share consideration, share exchange. Yeah. Access Bank and Diamond does that. Three, it might be in terms of deferred consideration. Dear accountant colleagues, you know, if I say deferred, deferred means postponed. Is that not? I can see somebody saying yes. Deferred means postponed. Deferred is an accounting term. It's just an English. Deferred is postponed. It can be cash payment. It can be share consideration when you exchange share. It can be deferred consideration. It can be contingent consideration. You all know what we call contingent. When something is urgent, it's what we call contingent. It's what we call contingent. Is that taken? And can be loan note or debt consideration known as exchange of subsidiary loan for share. Okay. So let's discuss each of the acquisition one after the other. Join me in discussing cash payment in the next slide. What is cash payment? How does it come about? Let's go. Cash payment. As you can see, kindly, I said it during the commencement of the lecture that you should be with your calculator, your pen, and your writing materials, because you are going to do an exercise and I will ask you to paste your solution before I do mine. We are doing it together. Don't forget, I said your maximum attention is needed because getting it is our joy. Cash payment. What is cash payment? Let me first use a layman language. Cash payment is when you buy something and you pay immediately. It's cash payment. You buy something and you paid immediately. You didn't promise the person to pay later. You pay your complete money immediately. That's what you call cash payment. Now let's go professionally. Cash payment shows the cash paid by the parent company, which can either be bulk payment of cash or share acquired. That is, the parent company pays immediate cash to the shareholders of subsidiary company for acquisition of the proportion in the subsidiary company. Can you see that? Cash payment is when the parent company pays immediate cash to the shareholder of the subsidiary company for the numbers of shares that they've acquired in that subsidiary companies. That is it. Let me take the case of Access and Diamond, because I know that this is what is common to us, and we all bank either with them or with other similar bank or with related bank rather. When Access Bank pay money to the shareholders of the Diamond Bank, they pay immediate cash, immediate money to the shareholders of Diamond Bank for the numbers of shares that they acquired in Diamond. It's called cash payments. The consideration will form part of the purchase consideration, which will be used in calculation of your what? Goodwill. Remember, in the goodwill, we have consideration transferred before we have add NCI value at date of acquisition. Don't worry. All right, let's get started. Bring out your writing material or your calculator. You're going to do a little exercise. Access Bank acquire 80% of Diamond Limited ordinary shares On 1st of October 2020, please not 2029, correct it, 2020, and agreed to pay 5 naira 5 kobo per share based on valuation. This is 2020, not 2029. And agreed to pay 5 naira 50 kobo per share based on valuation. The nominal value of Diamond Bank ordinary shares is 0.25 kobo is 10,000 naira. What is the cost of investment? I repeat, Access Bank acquired 80% of Diamond Bank ordinary share on 1st of October 2020 and agreed to pay 5 naira 50 kobo per share based on valuation. The nominal value of Diamond ordinary share of 0.25 kobo is 10,000 naira. What is the cost of investment? Do we know how to calculate cost of investment? First of all, ask yourself, were you given the total numbers of ordinary shares? If the answer is no, first determine your numbers of ordinary shares. Am I having a trial? Can I see somebody? Are you typing, what is the cost of investment? Or let me first ask, what is the numbers of shares acquired? Anybody, what is the numbers of shares acquired? Am I seeing someone? First of all, calculate your numbers of shares. Okay, let me assist you in that. The nominal value of Diamond ordinary share of 0.25 kobo is what? 10,000 naira. So to calculate the numbers of shares, your numbers of shares will be equals to, you have been given the nominal value of the shares to be 0.25 kobo. And they gave you the value to be what? 10,000 naira. So to get the numbers of shares, you just have your 10,000 naira value divided by the nominal value, 0.25. This will give you your total numbers of shares. What do you have? Is somebody typing? 10,000 divided by 0.25 will give you 40,000 shares, not 40,000 naira, 40,000 shares. Do we get same? If the answer is yes, then how much does Access Bank agree to pay? Access Bank agreed to pay 5 naira 5 kobo or 5 naira 50 kobo. Just say these shares. So your cost of investment now. Your cost of investment now will be equals to your 5 naira a month, 5 naira 50 kobo a month, or MPS, which is market value per share or price multiplied by shares times 40,000 shares. And this will give us what? What I use here is price times number of shares. Cost. To know the cost will be price times quantity. Is that not so? Cost is price times quantity, and the quantity here represents numbers of shares. So the price here represents the price that Access Bank agreed to pay for the share. So cost equals to price times quantity. Quantity is numbers of shares. So price times numbers of shares will be 5 naira 50 kobo multiplied by 40,000 shares. And what would that give you? You have it here. Can you see that? let me add to this that note that cost is equals to price times quantity. I'm using layman now. That is cost equals to price times quantities of share. Here you will say quantity of share, just say numbers of shares. And the price is 5 naira 50 kobo times the shares acquired 40,000 shares. So the cost of investment is just the cost. So the cost is 220,000 naira. Do we get that? If you are given any cost of investment, that is how to calculate it. Where you are not given the cost as in 220,000. Even if you are given the cost as 220,000, check your statement of financial position, your balance sheet, whether it is correct. Yeah, ICAN does that. But we are going to look at how to even determine that when we get to consolidation proper. I hope we are clear on this. If you are clear, can I see you typing yes? If you understand it, let me see you type yes. Okay. The next one is what I called share consideration. Do not forget that we have 5 types of cost of investment. The first one is cash payment. The second one is share consideration. The third one is deferred consideration. The fourth one is contingent. And the fifth one is exchange of shares, which you call loan note or debt consideration. Now we are on to the second one, which is known as share consideration. How do we do share consideration? For the share consideration, it is when the parent company use its share to acquire the shares of subsidiary company. That is, they prorate its share for that of the subsidiary company. That's why I said this occurs when the parent company issues share at market price in exchange of shares to the subsidiaries. And when such occurs, please note that the accounting treatment involves 3 legs. You see that I said the accounting treatment for the share consideration issued involves 3 legs. The first one is debit cost of investment and credit equity share and share premium. That is the 3 legs. When we say 3 legs, for some of us that have a practical accounting training, 3 legs means every accounting must have 2 legs, debit and credit. But when it's having another legs, then it might be 3 legs or 4 legs. That leg is under debit and credit, does not exceed debit and credit. That cost of investment under share consideration, remember that it is share exchange, which means the share of the subsidiary company would have increased. And when that share increased, we call it share premium. That's why I said credit or what? Share premium. And credit what? Equity share. Because the equity share of the subsidiary will increase, as well as the share premium will also increase. I hope that is taken. But note, if no share premium is in the statement of financial position, you have to create it too. Yes. If there's no share premium in that of the subsidiary statement or in your own statement of financial position, known as balance sheet, you create it. That is how it's done. Let's go to example. And under this example too, Bring out your calculator. You are the one to do the exercise. Okay. Before we go to that illustration, share consideration usually come from, let's say, A acquire B. We've all been seeing 2 for 3 shares. And we've all been seeing 4 shares of A, 4 shares in A for every 5 shares in B. That is what we call share exchange. When you see 2 for 3, 2 for 3 means 2 over 3. Then multiply by the numbers of shares of the parents, or numbers of shares acquired. If you see 4 for 5, it means 4 over 5. If you see 5 for 2, it means 5 over 2. 4 means over. Okay, let's go. L'Oreal PLC on 1st of January 2020 acquired, look at it too. Look at it too. Pay attention to the question. No. L'Oreal PLC on 1st of January 2020 acquired 24 million out of the 34 million issue equity share of Tollgate PLC. Hello. How many numbers of shares, or what numbers of shares was acquired? I can see somebody saying 24 million. That is what concerns you. What numbers of shares was acquired? You can see that L'Oreal acquired 24 million shares out of 30 million shares of Tollgate. It is the share you acquired that concerns you, 24 million. The purchase consideration was what? 2 shares in L'Oreal for every 3 shares in Tollgate. 2 shares of L'Oreal for every 3 shares in Tollgate. Now, the market price of L'Oreal share is what? 4 naira 80 kobo. What is the cost of investment? And what is the accounting treatment of the share consideration? Anybody? What is the cost of investment? And what is the accounting treatment? The first thing is, what is the numbers of shares acquired? You can see 2 for every 3, right? That is 2 over 3, multiplied by the numbers of shares acquired. Having done that, then multiply it by the market value of the share, just as we did under cash payment. That is all. Yeah, I have my solution. Purchase consideration equals to what? 2 for every 3. I told you 2 for 3 means 2 over 3. Multiplied by, you are only concerned with the numbers of shares acquired. That is why I underline the numbers of shares acquired. Nothing concerns you with 34 million shares. That 34 million shares is the total shares of Tollgate. I don't want to acquire the total shares. I only acquire 24,000. So it is the 24,000 that I acquired and not the 34. It is the 24 million and not the 34 million. So the one you acquire is the one that concerns you. So 2 over 3 for 24 million will give you 60 million shares. Therefore, value of the shares acquired will be this 60 million multiplied by the market price of your own shares, which is what? 4.80 kobo. And that will give me 76,800,000 800,000 naira. That is the value of the shares that I acquired. But remember, I use my share to acquire such investment. Okay? You will notice that the share acquired through share exchange is 60 million. That is the shares acquired out of the 50 million share. It means the remaining shares. You know that I said I acquired 24 million shares and I used 2 shares for every 3. So when I calculated the 2 shares for every 3, it means it's the 60 million shares that I actually acquire using shares. So using cash, this is it. Share. When I use share, I acquire 60 million. When I use cash, cash is just 24 minus 16. What does that give us? Use a calculator. 24 minus 16. That is 8. So it means I paid cash of 8 million. I paid cash for the 8 million shares and I use my shares for the 16 million shares. That's what it means. Altogether, I acquire 24 million shares. Is that taken? This is shares. This is shares. This is shares. I hope that is clear and well understood. Okay? If the answer is yes, are we following? Are we together? Please be noting how the shares, be noting the various acquisition methods that we have, the various cost of investment that we have. Just be noting it because it serves the basis of our consolidation. The next one is deferred consideration. When we say deferred consideration, it means deferred means postponed. And it occurs when the parent company does not pay part or full cost of investment and promise to pay in a future date. The cost of investment must be discounted to the present value using cost of investment. What do we use? First, you calculate your present value. Present value equals to future value in bracket 1 plus r raised to power minus n. That is what was done there. PV equals to future value in bracket 1 plus r raised to power minus n, because we have to determine the worth of that investment now. What is the worth of the investment for now? How much am I paying in the future? What was added to it? Obviously, if somebody don't want to pay you immediately, you know that that person would have to pay in excess. Paying in excess, it means that person will pay interest to what the person is paying. Is that not? And by so doing, it means the amount that will be payable will be more than what the person would have even paid for now. Okay? So, to calculate the interest will now be, I'm coming, interest will now be the future value minus the present value. But before we go to that, PV as I've used is present value. FV as used is future value. 1 is constant. 1 is constant. R is cost of capital, which I call rate of interest. R is the rate. You can call it order rate, you can call it cost of capital, but obviously they usually use cost of capital in the question. And your N is the numbers of years. N is the numbers of years. Is that taken? If the answer is yes, then let me be pleased to tell you that we are going to look at illustration now. Join me as we go through illustration. Yes. Okay, sorry, I have some explanation that the accounting treatment for deferred consideration includes the present value must be debited to the cost of investment and the unwinding cost. Sorry, unwinding cost that I use here, unwinding cost, I've explained that. Unwinding cost that I use equals to the interest. Unwinding cost is known as interest element. Interest is what I call unwind or unwinding cost. Okay, unwinding cost is interest, and that is as a result of person not paying immediate cash. So the unwinding cost must be debited to the retained earning of the parent company. Oh, that is the interest element, or you call it finance cost. The future value, that is the obligation for the payment, must be credited to NCI. You're going to see everything. Let's go to illustration because of time. Are we there? The parent company acquired 80% of the subsidiary company on 1st of April 2003. It paid 418 million naira and agreed to pay 108 million on 1st of April 2004. The parent company cost of capital is what? 8%. What is the cost of investment? And also show the consolidation adjustment required if consolidated on 31st of March 2004. When was the company acquired? 1st of April 2003. What is the percentage of acquisition? 80%. Are you noting it as I'm underlining them? How much does it pay now? He paid 418 million naira. How much does he agree to pay later? He agreed to pay 108 million. When? On 1st of April 2004. April 2003 and April 2004. What is the interval? The interval therein, the interval therein is what? 1 year. And that 1 year is your numbers of years. Is that taken? All right. Show the consolidation and how more and what is the cost of investment. So let's go. What is our formula once again? I hope you still have it. Okay. Remember that our future value, this future value, because he agreed to pay 108 on 1st of April, that has make it in the future. Our future value equals to present value, sorry, our present value. Our present value, PV, our present value, PV, equals to future value in bracket 1 plus R raised to power minus N. What is our present value? We don't know because the money was not paid complete. Not that we now take this 418. This 418 has already been paid. That is cash payment. That 418 is cash payment. It was paid as cash immediately. That is cash payment. The one that concerns us here is this 108 that was not paid. I think you are getting it. This 418 is cash payment has already been paid. We are less concerned. We've collected that. But this 108 that didn't pay is what concerns us. Okay. So how much does the company want to pay in the future? That is 108. Are we together? 1 plus, what is our R? R is order rate, is rate, or what you call the cost of what? Capital. The parent cost of capital is what? 8%. You can see it. So R is our what? 8%. 8% is 0.08. Raised to power minus. What is our year? How many year is it going to pay? What is the year? What is the year interval? The interval between 2003 and 2004 is 1 year. So our N is what? 1. Is that taken? So we now have 108 in bracket 1 plus 0.08. We give us 1.08 raised to power minus 1. Punch your calculator. What is now our present value? Therefore, our present value will be equal to what? Punch your calculator. If you punch your calculator, it's 108 multiplied by 1.08, close bracket, raised to power minus 8. If you are using this 108 is in million, don't forget. If you are using scientific, first of all, open bracket, punch 1.08, close your bracket. Having closed your bracket, locate where you have this in your calculator, where you have this sign. Press that sign. Having pressed it, look at where you have small minus. Put small minus and put 1. Then press is equal to. From there, times 108. It should give you 100,000 naira. Which means if this guy has paid us, he's supposed to have paid us 100,000 naira. No, 100 million naira for now. But because it's not paying 100 million naira now, that is why we'll be paying 108 in the future after 1 year. Which means the interest element, the interest that we've added is what? 108 minus 100, which is what? 8 million naira. 8 million naira is the interest that we've actually added. And obviously, if you calculate 80% of 100, it should also give you 8 million naira. Here is it. This is the 100 million naira that we've calculated in our previous slide. I hope you all see it. I hope you get it as we've calculated it. And the interest element unwinding cost is 108 minus 100 million, which is the 8 million naira. I've already explained that here. Okay. So the next one is the accounting treatment. Is the accounting treatment. The accounting treatment is debit your cost of investment. That 100 million that is supposed to receive now, debit it so that the total amount that we received. Remember that he paid us 418 million. He paid 418. Remember that he paid 418 million. And if he has paid us this 100 million, he's supposed to pay us 100 million, so that the money would have been 518 million naira. But he paid 418 and defer 100 million. That is what this one means. But in accounting for it, debit that 100 million to your cost of investment, so that we have the 418 million for goodwill calculation. Because goodwill should be your total. So it means the cash that we receive plus the amount that was deferred. Cash is 418 million that we receive, plus the 100 million present value that was deferred. If you total the two, we will have our cost of investment to be what? 518 million naira. Is that taken? So debit your cost of investment for goodwill, then that interest of 8 million naira, that interest of 8 million naira should be deducted from the retained earning of the parent. And when it is deducted, what do? You credit it. Then the money that has not been paid, this 108, you will recognize it under your consolidated statement of financial position. Okay, that is deferred consideration, it's a liability. And that one is going under non-current liability. I haven't put it, non-current liability, because it is the amount that is owing liability. Debit this, credit your interest. Is that taken? That is the accounting treatment. Any other question? Do you have question for that? The other two that remain is our share consideration and share is our contingent.
Okay, sorry. Some of them have questions, so I'm going to allow you guys to unmute yourself and ask your question. Kindly raise your hand up if you have question. Kindly raise your hand up. I can see some of your questions here. Somebody said, share more light on accounting treatment. Okay, some participants have raised their hand. So it's better you raise your hand so that we can pinpoint those that are asking questions. So Olayinka Bamsadesonya, I will meet you now to ask your question.
Okay, thank you, sir. Please, I need you to take us through the accounting treatment for share consideration. You omitted that part.
Okay, accounting treatment for share consideration.
Yes, sir.
All right. That's where we are now. Can you see your slide? Looking up PLC. Okay. Apology for that. So remember that I said the accounting treatment is 3 legs. 1, debit cost of investment. 2, credit your equity share and credit your share premium. And I said if the share premium does not exist, that you have to create it. Do not forget. So from our calculation, we have our purchase consideration to be 60 million shares. And I said the 60 million shares is that of the shares that we exchange for the share consideration, while 8 million was the cash that is paid. Is that not so? So the total shares that is acquired, that is the cost of investment. We debit cost of investment, debit cost of investment with what? 24 million shares, with 24 million. Then credit your equity share. Sorry, this thing is. Credit your equity share. Equity share is the share that you prorated, the share exchange, the share consideration. Credit your equity share with what? 16 million. Are we together? And what is the differences between the equity share and the cost of investment? You now credit your share premium. Your share premium, go back to the question. We have Loriro acquired 24 million shares out of the 34 million shares issued. Out of the 34 million issued equity share of Tollgate. Is that taken? And the shares consideration is for 2 shares for every 1 shares each. And remember, the market price of the share is what? 4.80 kobo per shares. But what is the nominal value of the shares of the Tollgate before? Is 1 naira. What is share premium? Share premium is when the amount of shares is greater than the nominal value. When the values of shares is greater than the nominal value. So your share premium will be, okay, let me write it here, please. So for your share premium will be 4 naira 80 kobo minus your 1 naira nominal share, which is what? 3.8 kobo. So that 3.8 kobo, now multiply it by the 16 million shares. You know, it is the 60 million shares that is being, it is the 60 million shares that is that we use as a share consideration. So you now multiply it by 60 million shares. So what do we have? 3.80 multiplied by 60 million. That will give us 60,000. That is 60,800,000. So you credit your share premium with 60,800,000. 60,800,000. That is your share premium. That is why I said, if the share premium does not exist in your statement of financial position, create it. I hope that is clear. That is the accounting treatment. Debit your cost of investment. Your cost of investment is the total amount of money that you acquire the shares, 24 million. Remember that the company is having 24 million shares and you use 2 for 3. You acquire 24 million rather, and you use 2 for 3. The total you acquire is 24 million. That is your total cost of investment. Your equity share is the shares that you give in exchange. That is 60 million, 2 of 3 of 24 million. That is your what? 60 million shares. That's your equity. Your share premium is the gain that the subsidiary company have as a result of prorating its share or valuing its share. And its share before is 1 naira nominal, and now it's having 4 naira 80 kobo. You can share the increase. What is the increase? The increase is 3 naira 80 kobo multiplied by the numbers of shares. So it will give you 60,000, 60,800,000. So that 60,800,000, now credit it as a what? Share premium. That is the accounting treatment. Can call it 60.8 million. 60.8 million. Credit share premium with 60.8 million. That is the accounting treatment for the share consideration.
Hope you understand.
I hope that is cleared.
Inca banks. Okay, just confirm that. You can send a chat to the box that you are okay with the answer.
Okay, thank you for that. Any other question, please?
So Mr. Wasio Alabi, he also has a question. So I'm going to unmute Wasio Alabi now to ask his question.
Hello, Mr. Wasalabi. Please ask your question. Go ahead.
Hello, sir.
Yes, sir. I can hear you now.
Hello, can you hear me, sir?
Yes, sir. We can hear
Okay.
you. We are with you.
Yes, okay, thank you, sir. Yes, I want you to explain the deferred consideration, the accounting treatment. Okay, I want you to explain the deferred consideration, the accounting treatment of deferred consideration. Explain it again.
All right. For the deferred consideration, unlike share consideration, that one is just two legs, debit and credit. And when we say deferred, what concerns us most in deferred consideration is how much would the person have paid now if the person has paid us cash? Then why the person promised to pay later? What is the interest attached? That is, how much interest have we added? You know that if you want to sell something and the person is ready to pay you immediate cash, the price will be less. But if the person wants to buy it on credit, obviously you will have to add interest. That's the business wise. Now, the first thing is calculate your present value, as we've done. You've calculated your present value and you see that the amount is 100,000 naira. And the person has already paid you 418 before. Since the person has already paid you 418 before, the interest that you've added to that 100 naira that will make the person to pay 108, interest is 8 million, as you can see it here. Remember that I said interest is the future value minus the present value. Interest is equals to the future value minus the present value. Future value is 108. And suppose the person have paid now, he would have paid 100, which means 8 million naira has been added as what? Interest. Is that taken? That interest, you credit it. Cost of investment, you debit it. Do you get that? Debit your cost of investment. What are you debiting? You are debiting the total cost, assuming that the person is paying you. You know that when you sell an item, you would have assumed that whether the person pay cash on in this thing, you would have assumed that the goods has leave your side, you sell it. That is, you've gotten the value. That is why we are debiting the cost of investment. That is, our cost of investment received the total value of 518. That 518, don't mistake to debit 108. You are only debiting 100 million. You are adding it to what the person has already paid before, which is 418. That is why I re-emphasize on this, that it paid 418 million. This 418 million naira paid is your cash payment. We are fine. The remaining amount that did not pay is the one that deferred 108. But suppose the person has paid the money now, the person would have paid us 100 million naira as calculated. Add that 100 million to 418, you have 518. This 518 is your total cost of investment. It's your total cost of investment. Do you get that? This total cost of investment, debit it because it's what? It's an asset. Debit or cost of investment asset. What do we do to interest? All asset and liability must be what? Debited. All expenses and income must be what? Credited. I said don't let us be too hard on ourselves. Use your simple accounting. Credit your interest. How much is your interest? 8 million. Just credit this 8 million. So debit, credit. Debit your asset. Asset is cost of investment because it's going to the equity side. But how much are you debiting? Know how much you are debiting. You are debiting 418 plus 100, which is what? You are debiting 518 million. Then credit your what? Your interest. I don't want to call it unwind cost. It is an interest. Credit your interest. How much is your interest? Your interest is the what? 8 million naira. If I ask you, how do I get the 8 million naira? Just tell me that it is my 108 amount I will pay in the future minus how much I should have paid now. Amount I should have paid now. That is interest, 8 million, credit it, that's all. Then that 108 that is deferred, you know, is a liability, is owing, the person is owing you. So you now go to your statement of financial position, balance sheet. Under balance sheet, we have current asset and non-current asset. We have current liability and non-current liability. Under non-current liability, please just state it as your word, deferred consideration, deferred consideration. Then 108, which is the amount that the person has not paid you now. That's all. Why is it under non-current liability? Because it's a long-term liability. It is for investment. Though the payment period is within an accounting year, we should have fallen under current liability. Is that not so? But look at the item. Is it an item of current liability? The answer is no.
No.
But the classification is nothing for us. Just go to your what is it called? SOFP, Statement of Financial Position, and just credit your liability as 108. If you don't know how to differentiate it, whether it is non-current or current, just put it under liability because the person is owing. So it's a liability. That's all. Is that taken? I hope that is clear.
Yes, it's clear.
Any other question? The other two are the same. Share exchange for loans is the same thing as our as our share consideration. And contingent consideration, that one does not have any distinction because it is when a transaction is urgent. Do we get that? It is just a form of investment that the parent company paid the subsidiary upon certain agreement. That is, the parent company says, if you do not meet up this, I won't pay this. That is what we call contingent. This contingent, as explained, this contingent, where is it? This contingent is based upon certain agreement, upon certain performance. Let me say based upon attainment of certain agreed performance. Now, let me give you a clue on this. Let's look at the case of Access Bank and Diamond. You know that Diamond was actually having issue and the bank is almost liquidating. When Access Bank studied the affairs of Diamond, and if Diamond should liquidate at that moment, it would affect the economy of Nigeria because our financial institutions are one of our major things that keeps the economy growing and booming. As a result of that, Access Bank now gave them a condition that for us to save you from your mess, this is what you must have achieved. First of all, remove your director and turn him to an employee. Then remove so and so, turn it to this thing. Then we can now acquire some of your shares. Then declare your assets. Then you will, all your logo. If you are, because we don't have the capacity to acquire you, we can only merge. Your logo, this is how we are going to do it. All your branches, this is how we are going to do it. Then some of your staffs that you created out of the office that they were not performing, we have to scrap them. It is when Diamond Bank meet up with those agreed performance that Access Bank were pleased to actually acquire some of their shares. If you are consistent with information, you will see that last year during the pandemic, Access Bank actually asked some of the staffs to go, and those are the staffs of Diamond Bank. When I get to the root, I asked, why is Access Bank sacking? Then CBN asks all banks not to sack their staff, and the government, is it government or CBN, either of them, they issued out this thing that any company that does not sack their staff during the pandemic will be given some tax allowances. As a result of that, Access Bank asked all their staffs to resume, but they still have their second plan. But what actually happens? Were some of the offices that was created by Diamond Bank, like a PA to a Tige, a PA to the manager, and they see that those offices were just collecting money, they are not performing. So they wanted to scrap those. That is part of the conditions that a parent company might give to subsidiary company before they acquire them. And that's what we call contingent consideration. Is that taken? So that contingent consideration at times comes in terms of the future payment when such condition is being met. No matter what, the three illustration is how the question comes, either for financial reporting or for corporate reporting. But financial reporting is only for cash payment and share consideration. At times they might text you on the deferred consideration. But my dear professional student, for corporate reporting, you have to know it all. Yeah. Any question before we call it a day? And in our next class, we'll actually be looking at consolidation procedures. What and what are we looking for? How do we consolidate? Okay, yeah, let me put it that way. Now, our next class will be looking for how to consolidate. Remember that consolidation is through line items. We consolidate line by line. And that line item is asset for asset, liability for liability, without the consideration of what? Share exchange. And without the consideration for cost of investment. So in our next class, what we'll be doing is practical. Less theory, more practical in our next class. Any question, please? If you have any other question, it's either you type it or you raise your hand. If you have question, please type it or you raise your hand. Do we still have question? Please, if you can't raise your hand, you can put it under the chat. All right. In example 2, what is the share premium? 60 million or 3.8? Yes. In the example 2, it is the 60 million multiplied by the 3.8, which is 60.8 million naira. That is the share premium. Okay. Yes, it's 3.80, as you can see, multiplied by 60 million, which is 60.8 million. That is our share premium. Is that taken? Any other question? The 8 million naira is an interest. That is just an interest element. You can't use interest as a share premium. So that is why it is not 8 million multiplied by 3.80. When we say share premium, premium is a gain on the shares that is acquired or sold. Let's say, for instance, a share with a nominal value of 1 naira was advertised and subscribed for at 1 naira 50 kobo. That 50 kobo is the premium on that shares of 1 naira. You now look for the numbers of shares that is being acquired. That is the numbers of shares that is being allotted. Look for the numbers of shares that is allotted. Let's say if the shares allotted is 1 million, then the 50 kobo is the share premium because the share nominal value is 1 naira and you advertise and people subscribe for it at 1 naira 50 kobo. That 50 kobo that is overage of that 1 naira is your what? Is your premium. Premium is a gain. Share gain is what you call share premium. So that 50 kobo multiplied by the 1 million, which is the share that is allotted, will be 500,000 naira. So 500,000 naira is the gain. Now come back to this case. The share that was being allotted, that is being bought, is what? The share is 24 million naira, right? Where's the shares? The share is 60 million naira, which is the share we use for exchange. 2 for 3 of 24 million is 60 million naira. And the nominal value of shares of toll gate is what? 1 naira each. That is the nominal value. But the share now, the share will now appreciate to 4 naira 80 kobo. So 4 naira 80 kobo minus 1 naira will give us what? 3 naira 80 kobo. So 3 naira 80 kobo multiplied by the what? 60 million shares that is being allotted. That will give us 60.8 million naira. And that is the value of our share premium. So our share premium to be recorded, to be credited, will be 60.8 million naira. Is that taken? I hope that is clear. You are welcome, sir. So please, any other question? Let's be free to ask questions because in our subsequent class, it's going to be practical. And in that practical, it's going to be where there will be a short explanation on the equity value. Yes, the equity value is the shares that is being allotted, this share that is being prorated, the share that we purchased. Remember that out of the 24 million, we said it is 2 for every 3, 2 shares in Loriro for every 3 shares of toll gate. That is 3 shares of toll gate. We will use our own 2 shares for his 3 shares. That is 2 over 3 multiplied by 24 million shares. And that one actually gives us what? 60 million shares. So this 60 million shares is equity share. That is the equity that, oh, even see from the top, I said credit what? Equity share. So that is the equity shares that we are crediting. And the value is 60 million shares. Yes, you know it is 60 million shares. If you want to find the value, thank you, sir. The value is 60 million multiplied by 80 million, which will be, you're actually crediting 76,800,000, which is 76.8 million. That is what you are crediting and not the numbers of shares. You are crediting this value. Credit this. That is the value that you are crediting. You are crediting 76.8 million. That is what you are actually crediting for the equity shares. Is that taken? Any other question, please? All right, sir. Thank you very much for that. Do we still have any question before we call it a day? In our next class, please feel free. In our next class, please prepare and also ensure that you are actually with your calculation. We are actually with your writing material and calculator, please. And for that next week, I will ask my host to actually unmute everyone, find a quiet place so that we can actually enjoy ourselves, because I don't like a situation. I want get it for once and understand it for once, not what we still be coming back to. Yes, at the end of today's lecture, please go through everything. Go back to our discussion. Go through the slide. Check it again. Ask questions before the next class. I'll be much available to answer all your questions. When you ask questions in our subsequent class, we will flow together. I believe that you would have understand this so that by the time that you are checking questions, because in our next question, we'll be looking at how do we consolidate? And how we consolidate, we have to look at, like I said, we have a standard format. Using that format, then how do we consolidate? What is the cost of investment? After a group structure, yes, we get the slide too. So how do we consolidate? After consolidation, what and what are necessary? What and what are we to do? By so doing, you will get it once and for all. And I promise you that with ICAN Online Tutor, your success is guaranteed in your ICAN examination. But do not forget to subscribe to our premium class so that you can have more questions to practice with. Thank you for that. Any question before we go? All right, requirement for the subscription. Just hold on. My admin will attend to you on that. Thank you very much for the compliment. I so much enjoy your class too, and I like your participation. Thank you for your time. Thank you for being attentive. Thank you. But please don't let it end here. By subscribing, we promise you more interactive class that we enjoy, that we guarantee your success. My admin will attend to you on the subscription requirements.
Okay, thank you everybody, and thank you for attending the class. So we have the premium class, which gives you exclusive access to the Zoom class. And also you have access, and unlimited access to all the recorded videos and audio lectures, which means you can watch this video again as many times as you want if you didn't get everything in the class. So I want you guys to join the premium class. Not to watch it on YouTube, it's just a few of our classes that we post there, just to let you know how our class sounds like. And we are currently doing the premium classes at a 50% discount. You can go to our website and check the prices on www.icanonlinetutors.com.ng/ICAN, or you can go to www.icanonlinetutors.com and then click in the menu, click ICAN. Yes, we see the price list for all the stages and papers there. So you can also chat with admin on WhatsApp on 0808 066 5292 or 0818 599 3275. Okay, see you the next class after this for the skills level. Okay, the skills don't have any class again today, so they would your next class will be tomorrow. I think everybody should have the timetable for this weekend. So and you should have the meeting ID, and the passcode for all the classes this week is 1. So you can simply join the next class for skills tomorrow morning. Then for professional, the next class is advanced audit and assurance, which will start by 11:30, and the class will be open by 11:15. Thank you so much, and have a wonderful day. Bye.